Hi, I'm Eddie Sanders and welcome to Your Finance TV. We're here with Jeffrey Hughes, founder at Alpha Insights. Jeff, welcome back.
Great to be here, Mehdi.
So Jeff published his big monthly piece on Saturday, and there's always so much to digest from there. I don't even know where to start generally. And don't forget, Jeff's note can be found on Substack at hugeinsights.substack.com. And since we published on Saturday, it's actually been a relatively subdued couple of days, so far this week. But it only takes one headline, as we all know. Jeff, do you want to just kick us off here?
We published our monthly newsletter, which is really a compilation of all of our really, deepest sort of well thought out sort of arguments over the past month. So we kind of go through this distilled analysis over the course of a month, which we publish to our institutional clients in our Alpha Insights publication. And then at the end of the month, we kind of take all that and we recreate the narrative and we say, this is what we've learned over the course of the last month. Here's the narrative. And we publish that as Huge Insights, the big picture. And what the note really attempts to do is kind of walk down from the top down to where we are at the market analysis level. And the newsletter is free to subscribe to at hugeinsights.substack.com. And we give a pretty good free preview. I think it's about a 20-page document. We give maybe the first 4 or 5 pages for free. And then if you want to read more, if you really find our work to be compelling, then for as little as $10 a month, you can sign up and become a paid subscriber on Substack and get access to the full report. And as you know, Mehdi, our paid subscribers actually get a lot of perks on top of the newsletter. Every Wednesday, we send out our top actionable trade idea of the week, plus some midweek sort of market update commentary to go with it. Then we do some other things on a quarterly basis, some quarterly video productions. We usually do keynote speeches at a number of conferences. Those are recorded, and we'll provide those to our paid subscribers as well. And I think it's a really good way to kind of keep in touch with what we think is going on. So what we did this month, as usual in our review and outlook, is we kind of went through all of the performance details and all the metrics on the market like we always do, and updated all of our models. And the conclusions continue to kind of be the same. Despite the fact that the S&P was up 7.5% in the quarter, the average stock was only up 2.4%. And despite the fact that the S&P was up 3.7% in the month of March, the average stock on a price-only basis was down 1.1%. And a lot of that is a function of small and mid-cap stocks dramatically underperforming. The Russell 2000 was down, I believe, almost 5%. And so people look at the headline, the S&P and the Dow, but it's really 7 stocks that have been carrying the market. And you know which ones I'm talking about.
That's it, Jeff. Thank you for that breakdown. And I want to remind and highlight to our viewers, Huge Insights by name and Huge Insights by nature, obviously. So I've always wanted to say that, Jeff. Let's kick right in because you obviously you start off. You've got your strategic risk model. It's still indicating risk on.
It is, and just so you know, we changed the name of it from the risk on, risk off model to the stocks bonds model. I just don't
Sorry,
like
Jeff,
that.
I'm still looking at an old version.
with all due respect, I'll allow Sarah Eisen to talk about risk on, risk off. She loves to do that. So, from my perspective, we really just kind of want to be on the right side of the major asset allocation trade. And so what we do is we take a broad swath of equities. We use the S&P 1500 as our universe, if you will. And then we compare that to the corporate bonds of those 1500 stocks. And we kind of look at it and we say, stocks versus bonds, what's the better thing to own? I mean, we could look at treasuries, but that has more of a flight to safety, element to it. Whereas corporate bonds really suggest, where the better value proposition is in the market. And right now, it looks to be that equities represent a better value proposition than bonds from a performance, momentum, and risk perspective, based on this model and based on our understanding of how this model has influenced the market. Recall that the model had been negative, and that goes back to maybe late 2021. I think it turned negative in November 2021. And then we got a neutral signal in, I believe, August or so of last year. And it remained neutral until October, at which point it flipped positive. And so, the allocation's now 80% equities, 20% bonds. That doesn't necessarily mean that we think, stocks are a great deal relative to bonds. It may very well mean that bonds are just way too risky right now. And that happens to be the way we feel about corporate credit. We think corporate credit is risky, and we think there's some risk to rates at this point. So we think rates will continue to move higher or stay higher for longer. But in the long term, say the next 18 to 24 months, we do think rates will be moving significantly higher, up into the 5 to 6% range on the 10-year Treasury yield.
Great, thank you for that clarification. Jeff, do you feel that the threat of a financial crisis has subsided to some degree?
We did until last month. Our liquidity risk model has turned neutral effective January 31st of this year. And what that means is that, we will overlay a hedge, something like a short equities hedge in the futures markets, or a long VIX hedge. Sometimes we'll buy call options on VIX futures. And in this particular case, when we did have a high risk signal in the liquidity risk model, we would carry a 10% hedge. Right now, we've cut that back to 5% due to the fact that we got a neutral signal. Now, the bank run that we saw in Silicon Valley last month does kind of raise our eyebrows. It did not turn the model back to negative, although it turned it down. And so we could get a negative reading. And I think any other sort of crisis that shows up in the banking realm will probably be enough to trigger it at this point. So with that said, we've got our eye on it, but it is neutral right now.
So, Jeff, obviously we're talking about the market being up for the last quarter, and things seem to be calmer. But when we look at the big picture models, things still look pretty scary. Can you talk us through this economic cycle model?
Yeah. So the economic cycle model is a very long-term view into kind of the structural cycle of the economy. What we do is we look at quarterly data for the Dow Jones Transportation Average, and we detrend that data. So the price data itself is what it is, but we detrend it so that we look at it on a momentum type basis. And we've got 110 years of that data, and we tested many series of data. And this is by far and away the most cyclical by orders of magnitude. And so it really gives a very good pulse of what's going on in the economy from a long-term perspective on a quarter-to-quarter basis. And what we did is we identified a cycle, a very discernible sine wave to that momentum structure. And what it determined was that about every 34 years, a Fibonacci 34 years, we see a new low in the cycle. Well, that means that about every 17 years, from low to high, we'll get that peak, right? And so what we saw from the 2005 cycle low was a 17-year advance that carried into 2022. That was scheduled to peak around mid-year 2022. It peaked a little bit early. It was a little left-hand translated, but it appears, based on how the price action has changed, that certainly we did see a legitimate peak in the cycle. And that cycle is now set for a 17-year decline. That is, the momentum of the economy is in a long-term decline for the next 17 years and isn't expected to bottom until about 2039.
Ouch. No one wants to hear 2039 is the bottom. Um, while we stay on the big picture, there was a decline in the real M2 money stock. What are the actual implications of this?
Yeah. Well, so real M2 money stock has been in decline since about October of 2021. The thing that's really noteworthy is that it's down 7.9% on a year-over-year rate of change basis. That's a new all-time record low, and this data goes back to January 1st, 1960. So, what's really, I think the implication at this point is simply this, that liquidity is being drained from the system. And I think a lot of people are confused by the fact that the Fed's balance sheet jumped by about $350 to $400 billion over the course of the last month as they started a new, bank lending facility, and banks were forced to run to the discount window with collateral in order to generate liquidity. So as a result, the Fed took in all of this collateral, almost $400 billion worth, and lent out short-term reserves to banks so that they could facilitate the liquidity needs of depositors, right? But that doesn't mean that that money is being multiplied in the system. It's not a credit function, it's a liquidity function, because liquidity was so tight, the Fed was forced to inject $400 billion into the system just to make sure that it didn't collapse, okay? So the reality is liquidity is being drained from the system, and the Fed will continue to drain or let about $95 billion a month in existing assets roll off the books month after month. That has not changed. So they'll continue to unwind their balance sheet. But I think this $400 million or billion dollars in collaterals, that's a sidecar relative to the real argument with respect to liquidity in the Fed's balance sheet. It's showing up in the real money stock, the M2 money stock, as being historically historically fast drain. And honestly, the thing that worries me the most about this is, M2 money stock rose by nearly 25% in 2020 because of the COVID pandemic and the amount of liquidity that the Fed was forced to pump into the system, almost $5 trillion. And so when we think about that historic overshoot, I mean, prior to, April of 2020, the highest rate of change that we ever saw in the history of this data was 10%. Well, we increased that by 150%. And so what if we overshoot the prior low of 6.5% negative by 150%? We could be looking at something on order of, mid-teens sort of decline. So we might only be halfway there in terms of the year-over-year rate of change. We'll see how that pans out, but I think it's definitely very bearish, and it speaks to the potential for deflation.
And and just to time with that, we're going to explore the dollar as well, but that probably helps add to your conviction on the strength in the dollar as well.
Yeah, well, the dollar has been weak in recent months, but it's been very, very strong over the course of the last couple of years. And our view has been, with respect to the dollar, is that, honestly, we think the dollar's in a new bull market, and we've reached a consolidation phase, okay? And this consolidation phase, as long as the dollar holds above par, then we think, it's good. The trend remains up. Our target continues to be 120 on the dollar. And I think, if we see this global liquidity sort of drain continue, there will be a demand for dollars that will, pump up the US dollar relative to other currencies dramatically. And I think the dollar index will hit our target. So we remain kind of optimistic about that,
and we'll take
which is actually pessimistic.
Yeah. Looking at the Economic Conditions Board, we look at this every month. It seems to be screaming something about recessions. What do you have to say here?
Yeah, well, the Conference Board publishes the leading economic indicators index. These are the 10 leading economic indicators. They've been publishing this series for well over 40 years. And in the history of that data, what they determined is that, when the LEI hits negative 4%, that's a trigger that signals, kind of that basically a recession is imminent. Okay, it sets the clock, right? And they've got a 100% hit rate on this. Once the LEI indicator breaks -4%, on average, within like 6 to 10 months, and they use 7.5 as kind of the midpoint, I think, you get a recession. It kicks off, and so the trigger was ticked on August of 2022. So we are, basically rapidly running into that 7.5 month point. And what it basically points to is a second quarter recession. And so we should begin to see pretty serious evidence of a recession begin to emerge as we see the second quarter of 2023 play out.
So that rolls us into triggers. You mentioned it there. Obviously, everyone's favorite topic of conversation. Where are we going on the inflation front?
Yeah, a lot of measures of inflation have been receding. Even the Fed's, favored core PCE came in better than expected, ticking down to 4.6% from 4.7% year over year. That being said, other measures, and you might be aware that the Fed basically has 9 different calculations for core inflation, right? And some of the various Federal Reserve banks have created their own models, right? The Cleveland Fed has the median CPI, and that is also a measure of more core inflation. And believe it or not, that measure actually posted a new all-time record high in February after posting a new all-time record high in January. So that's 2 consecutive new record highs in a row. In addition to that, the San Francisco Fed's, I believe they call it the cyclical core PCE, that model posted a new all-time record high in February of 8%. And so I think the net here is that the jury is still out on inflation. And if we take the aggregate of all of these, Federal Reserve Bank models, all 9 of them, and just average them together, we come up with something like 408 basis points above the Fed's target of 2%. So, given that, I would say that the Fed still has some wood to chop with respect to inflation.
All right, so that leads me nicely into my next question. Do any of these data points and things you're seeing change your stance on the upcoming FOMC decisions?
Well, we're reliant really on the market for, an opinion, if you will. The Fed, actually, the CME group has a great tool called the Fed Watch tool, and it's the Fed Funds Futures Curve probability calculator, basically. And what it does is it uses the Fed Funds Futures Curve to determine the probability of a rate cut, in the upcoming period, right? And so the next FOMC meeting is May 3rd. And the CME tool, the Fed Watch tool, is actually suggesting that the odds are favoring a 25 basis point hike now as of this morning. The odds are 59% in favor of a 25 basis point hike on May 3rd, and I think 41%, against. And so at this point, it looks like the consensus view is that inflation's still running hot enough to warrant some additional tightening.
So looking at the yield curve, it looks like we do have further steepening, but this isn't really what's concerning you.
No, it's not. Everyone knows that an inversion in the yield curve is a great predictor of a recession. The problem is those recessions emerge 10 to 33 months in the future. So how do we narrow it down, right? I think that the inversion of the yield curve is the warning sign. It's the shot across the bow, right? But what's really important is when the yield curve begins to re-steepen. That's the signal that the torpedoes are in the water. That's the indication that the recession is imminent, that it is commencing, right? And so we believe that that's occurring. The evidence is that the yield curve is beginning to re-steepen. We've seen it move back up from its lows of around 89 basis points inverted at month end February to, I think, only 58 basis points inverted as of March 31st. And so that modest improvement or the re-steepening of the yield curve is an indication that, recession is commencing.
So, Jeff, obviously we have time restrictions, but this is your monthly piece. You examine all sorts of things, a lot of asset classes, and part of that is you examine the fixed income portion of one's portfolio. Obviously, the viewers can get more detail from your report, but just as a 5-second recap, is it fair to say that you would favor short over long duration bonds, inflation protected versus fixed rate, and low quality versus high quality?
Yeah, I would agree wholeheartedly with the first two of those. We are definitely shorter on duration, and TIPS have been outperforming fixed coupon bonds. That being said, when we look at the corporate bond market, we are getting some evidence that we're getting a reversal in that prior model reading. And so, we had been favoring low quality bonds over high quality bonds in the corporate credit realm. That is reversing. We have not gotten an official reversal signal, but looks very, very close. So it's on watch right now for a reversal.
On watch, keep an eye on the corporate bonds. Let's have a look at some of the technicals, Jeff. S&P 500.
Yeah, so let's talk about the Elliott wave view. We look at this from two perspectives. Number one, the fact that markets can correct in price, and number two, the fact that markets can correct in time. And so, our preferred count right now suggests that markets are in the process of correcting in price. We expect to see a very, very deep price correction relative to a very long-term model that suggests that back in January of 2022, we ended cycle wave 5 of super cycle wave 3. And so we are in a super cycle wave 4 corrective waveform right now. That should be at least a 3-wave ABC correction that will likely retrace something on balance of 1/3 to 2/3 of the entire advance dating back to 1932 and ending in 2022. Now, if that's correct, it will happen like this: a motive wave, a corrective wave, and a motive wave. A motive wave is 5 waves down. And so it happens like this: a 1, 2, 3, 4, 5. The 1, the 3, and the 5 are also motive waves, and the 2 and the 4 are corrective waves. What we've seen so far since January 22 has been one motive wave to the downside that's completed. That's primary wave 1 down, and that ended in June of 2022. And one corrective waveform at primary degree. That's primary wave 2, and that ended August 16th, 2022. Since that time, we've seen what appears to me to be a lateral consolidation that is really just the subdivisions of primary wave 3 down. So the decline into the October 13th low, that was just intermediate wave 1 down of primary wave 3 down. And the rally into the February 2nd high was intermediate wave 2 of primary wave 3 down. So if our calculations are correct, we are in the midst of intermediate wave 3 of primary wave 3 down. And once we get through these minor sort of waveforms, minor 1 and minor wave 2, minor wave 3 will kick off what I believe will be a third of a third wave decline that will be an epic plunge down into the mid 2000s with respect to the S&P 500. Now, if I'm wrong about that, and if in fact markets will correct in time as opposed to price, then we think that we probably haven't finished this cycle wave 5 yet. And so our alternate count on the right-hand side of this chart illustrates the potential for this entire correction to have just been intermediate wave 4 of primary wave 5, of cycle wave 5, which have yet to complete and will complete at a new all-time high. So that is a potential. That potential does not become a high probability until and or unless the S&P 500 can exceed the August 16th high, and that's a level of around S&P 4325. So if in fact that were to occur, then I would have to suggest that the alternate count is in play. However, if the market breaks below 3764, then that would eliminate that count altogether, and there would be absolutely no doubt in my mind that the preferred count is correct.
So it seems there's a lot more wood to chop on the upside potential on the alternate versus the preferred.
I think so, absolutely.
Now, looking at these long-term models, how does trend look?
Well, we run a long-term trend following model, which is a combination of two moving averages, and we're looking for a crossover. The base moving average is a long-term moving average in and of itself that defines the trend very, very well. Right now, it is essentially flat. The faster moving exponential moving average, which is illustrated in green, that is the signal line. And when that crosses above the baseline in red, then we know that there's a high probability of a trend change. So far, that hasn't happened. In fact, the last signal that we saw was late March of 2022, when the signal line crossed below the baseline, indicating a bearish or negative signal. And so this trend following model is negative now. It remains negative. It's getting close. So we've seen, as you can see, things got very, very close. Then we got a run on the bank in Silicon Valley. They rolled over and widened out, and then everything, got, joyous again. People got excited because the Fed came to the rescue, and all is well, right? And so now we're seeing things start to turn up slightly again and converge, but we have not yet gotten the signal. And in fact, as of the March 31st close, the positioning between the two moving averages actually further away than it was at its tightest point. And so, I continue to look at this model, and I am very surprised that we haven't gotten a signal, right, with the way the market's been behaving. But so far, unless we get that crossover on a monthly closing basis, this signal will remain on a negative bias, meaning a sell signal.
Jeff, let me skip ahead to a couple of other points that have been quite hot topics. Excuse me. And obviously, I'm very conscious of your time. Volatility. Volatility has been coming up in conversation more and more, and we've discussed that 40% level. Do you feel that that's kind of on the book still?
I do. Here's the thing. The VIX has probably been the biggest surprise to us, despite everything that's happened in the last month. I mean, with inflation, with the bank run, with the Fed coming to the rescue, you would have expected the VIX to print at least as high a number as it did in 2022. No, we got to 31% on a spike, and it almost immediately reverted back to sub 20%. It took days, not weeks, for that to occur. And we got down to 18.7% at monthly close. Now, this is to some extent something that I would expect, that volatility and investor sentiment would become complacent as the market is reaching a level that is likely to be a terminal point in its advance. And that's our view, right? Our technical view is that the market is reaching its terminal point right now, and it's about to roll over hard down. And so the VIX is exactly where it should be. There's no fear, none in the market. So at this point, the VIX is where I would expect it to be today. And sometime in the second quarter, I would not at all be surprised to see the VIX print 40% or higher.
Got it. And all said and done, Jeff, we keep coming back to one simple fact. Valuations are high, and they will curb any relative upside. So could we still, I know you touched on it in regards to your alternate count, but we could still potentially extend further here on the valuation
I
side.
think I think it's a low probability. I mean, we've been higher, right? The peak in the Shiller Cape ratio was 38 times. We're now at about 29.4 as of month end March, right? The price to sales ratio got up to 3 times. We're at about 2.4 right now, which, by the way, is still higher than the price to sales ratio peaked in 2000 during the dot-com bubble. So, we're at epic extremes right now with respect to valuation. Yields like 1.6%. Price to book is maybe 4.1 times. I mean, we're talking about, market cap to GDP is 155.7. Now, these aren't the highs, got up over 200% at one point. So things have come down, but we're still at extremes, right? The Shiller Cape ratio today at about 29.5 times is almost as high as it was at the 1929 peak when it hit 32 times. So, my point is simply this: the valuation does cap the upside. We're not going to 5,000 on the S&P. That is not likely to occur. And it's not that it's impossible. Anything's possible where human emotions are involved. And the stock market's nothing if it's not a barometer of human emotions, right? So people could get super excited about something, AI, I don't know what it is, but at the end of the day, it's highly improbable that earnings are going to expand this year. In fact, if we look at S&P Capital IQ earnings estimates, we're actually looking for earnings to be down year over year. They're estimating $218.50 for 2023. I think that the estimates for 2024 are just crazy. $248. That's not going to happen. Okay, people that are betting on $248 in earnings next year are making a big mistake. We're going to see a massive revision in earnings for next year, and we're going to see probably further revision this year. I think earnings will be sub $200 this year. Those revisions will probably start to come to fruition in the second quarter here as people start to realize that we're in a recession. And historically, earnings get revised down between 20 to 40% during a recession. I think, say we see a 10 to 20% revision range. I mean, that's going to be enough to really bring things down to a sub 200 level. Some people are out there saying 190. That's not off the table either. Could be worse, but there's no way we're going to print $248 in earnings next year. And I think valuations just won't be able to support higher prices in the S&P 500.
And we've seen a lot of these corporates, stay on track with some of their earnings numbers based on a reduction in capex versus actual growth in revenue side. So, how long can that party continue as well?
Yeah, you're absolutely right. That's a great point. I mean, you're basically, killing future growth in order to sustain your current earnings base, right? And that's not a winning solution long term. So, yeah, and you can see it in tech with all the layoffs, right? R&D is the lifeblood of technology companies, and when you're cutting employees by the tens of thousands, chances are you're going to not just have a negative impact on morale, but people are going to be keeping their best ideas close to their vest.
Absolutely. You looked at some macro assets. Obviously, we're not going to go into all of them, but there's a couple that are recurring themes with our viewers: gold and the US dollar. If you could just give us a little recap on the thoughts here.
So I think I kind of covered the dollar earlier. So let me just talk about gold. We like gold, and we've been neutral from a technical rating on it because gold had been failing to make a new high, right? And so part of our discipline is we like assets, sectors, stocks that are breaking out to make new 52-week highs. And until that happens, we're going to kind of sit and wait it out, right? Well, guess what happened in March? On March 31st, gold closed the month at a new 52-week closing high, which incited us to take a closer look at our rating. And as a result, we upgraded gold to bullish from neutral and took our target to $2,500. We think gold has significant upside from here, and we would advocate making gold a core part of any portfolio. We think it tends to prove to be an excellent hedge in times of financial crisis and struggle. And so if our liquidity risk model, which we discussed earlier, is neutral right now, maybe gold's a way to kind of, hedge your hedge bet, right? Until that model ticks back to, a high risk function again. And we think that that's something that could potentially occur with the next crisis. Be long gold as a way to get in front of that. That would be our plan.
Flight to safety and the shiny stuff. Old school. You deep dive, obviously, all the sectors. Are there any that jump out that you'd like to mention here?
Yeah, there's two. Number one, let's talk about energy. Energy continues to remain our top ranked sector in our sector relative strength work. It has been positively ranked. We admit that energy has been poor performer in the first quarter, but we think the consolidation was complete. And in the chart, we indicate that the trend held, right? And so we got a big, long shadow on the downside here, consistent with kind of a hammer candle form, which, we believe is consistent with gold, oil and energy stocks actually reasserting themselves. And lo and behold, yesterday we saw, a big production cut come out of Saudi Arabia out of the blue, kind of a bolt from the blue, and energy stocks spiked up. And that does not surprise me because the supply demand dynamics continue to support, this sector. And it's become very underowned because of its poor first quarter performance. Conversely, technology became very overowned, okay, with a very high concentration in the largest mega cap high quality names: Apple, Microsoft, Google, Amazon, Tesla, Nvidia. These stocks were Meta, okay? These were the best performing stocks in the first quarter. Without their performance, first quarter performance would have been nothing to write home about. Frankly, it's one of the reasons that we've seen this narrowing of breadth that we talked about earlier, right? Because all the capital's kind of hovering around or huddling around in these 7 names. Everybody owns them. They're the most overowned stocks right now. And, their valuations are at absolute historic extremes, even exceeding the valuations that occurred at the peak of the bubble in 2021 and the peak of their growth dynamics. And so this looks like it's a good pairs trade to me to be, long energy, short tech right now. If you're not short, just underweight tech and overweight energy if you're not a hedge fund. But that's the way I would look at the sector play right now.
Fantastic. Now, as always, let's wrap up with some money-making ideas. Let's some actionable trade ideas. What do we like this week?
Well, and after that soliloquy on how I think you should, underweight short tech, there's a tech stock that actually does look attractive, and it's in the semiconductor space. And semiconductors, in my opinion, are the one area of technology that look like they've got, some fuel in the tank still, and can continue to go. And one name that jumped off the page to us is Motorola Solutions, which is more in the telecom side of the semiconductor space. The symbol's MSI. Stock went out around 285 last night. It broke out to close above 270 on a weekly and monthly closing basis. And that triggered a breakout of a classic pattern base formation of the cup and handle variety. That base dates back more than a year, and the breakout actually counts to about $340 on the upside. Now, if we're wrong about this, then the stock, well, if we're right about it, the stock should not come back and trade through the 268 level. So that's where we want to put our stop loss to protect capital, and that would set up a nice 4-to-1 positive risk skew on this name. On the short side, an industrial name that comes out. And by the way, you can short any bank and probably make money. But I wanted to kind of get away from that because we spent a lot of time on it over the course of last month. There's a company called Titan Wheel International, or I guess it's just Titan International now. The symbol's TWI. This stock closed at about $10.65 last night. it broke down below $12 to resolve a double top formation, a classic double top formation after breaching trend. And that double top actually counts down to around $4 a share. This stock's been as low as $1. So there's no question that if we get a recession and orders start to fall off, and we're already seeing evidence of credit crunch, right? And that credit crunch will probably lead to orders falling off before we're in full-blown recession. But once the economy hits full-blown recession, Titan Wheel is extremely economically sensitive business, and we should see this stock just collapse. I would say the stock will be $4 before it sees $12 again. So I'd set my stop loss at 12 just to protect capital. This sets up, I think, a really nice, maybe 6-to-1 positive risk view.
Wow, great stuff there, Jeff. And obviously we ran a little longer than usual, but there was so much to unpack in your monthly. It's just hard not to cover these topics. So thank you for your time today, Jeff.
Well, you're very welcome. It was only 76 pages instead of 100 this month.
There we go. And to our viewers, I want you to check out Jeff's content. It's available on Substack at hugeinsights.substack.com. Until next time, good luck investing.